What if the money sitting in your own bank account, money you worked decades to earn, suddenly put you on the CRA's radar? What if a single trip to the bank, one simple transfer, or even a pattern of withdrawals triggered an automatic flag that led to a formal audit, a demand letter, or worse, a penalty that could wipe out thousands of dollars you simply cannot afford to lose at this stage of your life? This is not a hypothetical situation. This is happening to Canadian retirees right now in 2026, and the enforcement environment has never been more aggressive. The CRA has quietly expanded its data matching systems, its bank reporting requirements are tighter than ever, and many seniors have absolutely no idea that their everyday banking behavior could be raising red flags at this very moment. If you are receiving CPP, OAS, or any pension income, and you are regularly moving money around, making cash deposits, or receiving funds from family members, you need to hear every single word of what comes next. Because what you don't know about the CRA's current monitoring practices could cost you more than $10,000. And that's not a number you get back easily in retirement. Stay with me. This gets very specific and very real. The problem and why it starts at your bank branch. Let's be absolutely clear about something. The CRA does not need to knock on your door to begin building a case. They do not need to call you on the phone or send you a letter first. The monitoring starts long before you ever hear from them, and it starts at your bank. Canada's financial institutions are legally required to report certain transactions to FINTRA, the Financial Transactions and Reports Analysis Centre of Canada. FINTRA is the federal agency that monitors financial activity for signs of money laundering, tax evasion, and unreported income. Your bank is not asking permission to share this information. They are required by law to do it. And once that data flows into the system, the CRA has the tools to cross-reference it against your tax return faster than you might think. Here is where it gets personal for you as a retiree. Your income is mostly fixed. CPP, OAS, maybe a workplace pension or RRSP withdrawals. The CRA knows what you reported. Their automated systems know what your expected income range looks like. So, when your banking activity doesn't match that profile, when money is moving in ways that don't align with what's on your T1, that mismatch can trigger a closer look. This is not about being dishonest. Many seniors are caught off guard because they didn't know these rules existed. A gift from a child, a loan repayment from a friend, selling personal property, consolidating old accounts. These are all perfectly normal activities, but if they aren't handled carefully and documented properly, they can look suspicious to an automated system that has no idea about the context of your life. And before we go any further, if this channel is helping you protect your retirement, please subscribe right now. Every week we cover CRA updates, pension changes, and financial warnings that directly affect Canadian seniors and retirees. Hit that subscribe button so you never miss an update that could protect your money. The evidence, what the CRA is actually watching. Let's get into the specifics because this is where most seniors get blindsided. First, cash deposits. Any single cash deposit of $10,000 or more triggers an automatic large cash transaction report at your bank. It goes directly to FINTRA. No discretion, no judgment call by your teller. It is automatic and mandatory. Now, the deposit itself is not illegal. But if the CRA sees that deposit and you have no corresponding income entry on your tax return, no explanation for where that $10,000 came from, they will start asking questions. Second, structured deposits. Here is one that catches people completely by surprise. Let's say you have $12,000 in cash and you decide to deposit $4,000 on Monday, $4,000 on Wednesday, and $4,000 on Friday, all to stay under the $10,000 reporting threshold. That pattern is called structuring, and under Canadian law, intentional structuring to avoid reporting requirements is itself a serious offense. The CRA and FINTRA are trained to spot exactly this kind of pattern. What feels like smart planning to you can look like deliberate evasion to them. Third, e-transfers and digital payments. This is the modern blind spot for many seniors. Receiving regular e-transfers from your children, grandchildren, or other family members can raise flags if the amounts are consistent and ongoing. The CRA systems look for income that isn't declared. If you are receiving $1,500 every month from your son or daughter, even if it is simply family support, and you are not reporting it or documenting it as a non-taxable gift or loan, the system may flag it as undisclosed income. Fourth, account consolidation and large transfers. When you move money from old savings accounts, GICs that matured, or sell an asset and deposit the proceeds, those movements register. If the CRA's data matching system sees a large inflow and cannot connect it to a declared source, it becomes a discrepancy. Discrepancies lead to reviews. Reviews can lead to audits. Audits can lead to penalties. And in serious cases, those penalties begin at $2,500 and can escalate to $12,000 or more, depending on the nature of the finding. Fifth, foreign money. If you are receiving funds from outside Canada, even from family abroad, there are strict reporting requirements. Receiving more than $100,000 from a foreign source in a calendar year requires a specific CRA disclosure. Many seniors who have family overseas or who sold property in another country simply don't know this rule exists. The consequence loop. This is the part most retirees skip. Many retirees hear the first part of a warning like this and think that doesn't apply to me. They turn off the video right here. And that is exactly why some of them end up with CRA letters in their mailbox 6 months later, completely shocked. You cannot assume the system won't find you. The CRA's current data matching technology is sophisticated, and it is being actively expanded. They now receive banking data, property records, investment platform reports, and third-party income information automatically. You don't have to do anything wrong to get flagged. You just have to have unexplained activity in your account. And when a senior gets audited with no documentation, no paper trail, and no professional guidance, the outcomes are rarely good. The burden is on you to prove where the money came from. If you can't prove it, the CRA may treat it as income and assess taxes, interest, and penalties on amounts you never earned as taxable income. So let me ask you directly right now. Have you ever made a large deposit like the ones I've described? A cash deposit, a big family transfer, or proceeds from selling something valuable? Drop a yes or no in the comments below. Your answer helps us understand exactly what information you need most, and it keeps this conversation going for every other senior watching. The solution: your 5-step protection plan. Now, let's shift to what you can actually do about this, because awareness without action is just anxiety. Here is your practical protection plan. Step 1. Document everything. Every large transaction, whether it's a deposit, a transfer, or proceeds from a sale, needs a paper trail. Write it down. Save the email. Keep the receipt. A simple note in a folder explaining where the money came from can protect you in ways you can't imagine. Step 2. Report your income accurately and completely. If you received money that could be considered income, rental, payments, business activity, freelance work, report it. If you are unsure whether something counts as income, do not guess. Find out. Step 3. Do not structure your deposits. If you have a large amount of cash to deposit it at once and keep documentation of where it came from. Splitting deposits to avoid reporting thresholds creates far more risk than the original transaction would have. Step 4. Clarify family transfers in writing. If a family member is giving you money regularly, get something in writing that confirms it is a gift or a loan, not payment for services. A simple signed note with a date and amount is often enough to remove ambiguity. Step 5. Speak with a Canadian tax professional, not a general financial planner. A tax professional, ideally a CPA or a tax lawyer who works specifically with seniors or retirees. 1 hour of professional advice can save you thousands of dollars in penalties, interest, and back taxes. The CRA moves quickly. Get ahead of it before it gets ahead of you. The CRA is not going away. Their systems are only getting smarter, and their reach into Canadian banking data is only getting broader. You have spent your entire life building what you have. You earned your CPP. You paid into OAS for decades. You deserve to protect every dollar of it. But here's the question I want to leave you with, and I genuinely want to know what you think. Do you believe the CRA's monitoring of ordinary Canadians' bank accounts has gone too far? Is a system that flags seniors' family transfers and cash deposits actually protecting Canadians? Or is it creating fear and hardship for people who have done nothing wrong? Leave your opinion in the comments. Tell me your experience. And if you know another Canadian retiree who needs to hear this, share this video with them today, because the people who don't see this are the ones most at risk.